Formal sector employment has slumped. During the first quarter, jobs decreased by 0.7% on an annual basis and by 0.6% on a quarterly basis. The decline was led by losses in the trade, community services and mining industries. Both the full-time and part-time employment decreased. Brait has posted an 8% decline in annual net asset value per share, but the investment holding company has narrowed its losses. For the year to end March, a headline loss per share of 13 cents has been reported. That's from a loss of 70 cents previously. The results come as Brait embarks on a recapitalization strategy to reduce debt and strengthen its balance sheet. The firm says this move provides runway for all stakeholders to benefit from the continued recovery in Virgin Active and New Look and the growth in Premier. Exxaro expects its first half coal output to fall. The miner says total production for the period is likely to be 14% lower. Sales volumes are also projected to fall by 12%. That's due mainly to reduced demand from Eskom at Grootegeluk. But the firm says that total forecasted production remains within 2% of the guidance it provided previously. Ainsley Holdings, known as IBEX, has completed the successful placing of 500 million Pepkor shares. The move has raised 9 billion rand for the group. The shares were placed at 18 rand apiece, representing a 7.7% discount to the pre-launch Pepkor share price at market close on June the 24th. Once the placing is complete, IBEX's interest in Pepkor will be reduced from 43.7% to about 30.2%, and the free float of Pepkor will increase from 56% to close to 70%. Barclays Bank, Investec Bank and JP Morgan Securities acted as joint global coordinators for the placing. Settlement is expected to occur on June the 28th. Orion has requested an immediate trading halt. The copper developer says this needs to be done as it anticipates making a material announcement in relation to a proposed capital raising. The firm has requested the halt until markets open on Thursday or until it makes the announcement, whichever comes first. On the international front, Airbus softened key industrial and financial targets and took a hefty charge for its troubled space activities as Europe's largest aerospace group sought a clean slate approach to supply disruptions and commercial risks. Let's take a look at this package report for more.
Airbus says it's facing up to some tougher times ahead. The company has cut key production targets for its jetliners and taken a big charge on its troubled space business. Boss Guillaume Faury says the firm is facing headwinds right now. We have to bite the bullet. Airbus has cut its closely watched forecast for airliner deliveries to around 770 this year, down from about 800. Industry players had long been sceptical that it could hit the original goal. The world's largest maker of airliners has been hit by output delays caused by parts shortages. It says the supply of engines for its best-selling A320 jets has deteriorated significantly in recent months. Plans to ramp up production of the planes to record levels are being put back as a result. Faury said engine makers would have to face the consequences of delays, hinting they could face penalties. That could hit firms including Pratt & Whitney and CFM, co-owned by GE Aerospace and France's Safran. Airbus has also taken a charge of about $965 million over its troubled space unit. The company has cut its financial targets for the year as a result of all the problems. It now expects operating income of about $5.9 billion, $1 billion or more down on previous targets.
And the EU could hit Apple with a huge fine after accusing it of breaking new tech rules. Here's our reporter Ndawling Lechela with more of the detail.
That's right, Zinati. EU's antitrust feud with tech giant Apple is deepening. This as Brussels levels its first charges under its new competition rules. And joining us with more is DW correspondent Chiponda Chimbelu in Berlin. Chip, thanks for your time today. Now, as we get started, just update us on the latest on that front.
Thanks for having me. Well, the EU has accused Apple of preventing app developers from directing users to cheaper options outside the tech giant's App Store. The European Commission says that a preliminary investigation has found that restrictions that the iPhone maker imposes on developers breaches its Digital Markets Act, the DMA. Now, this marks the first time that Brussels has leveled charges under that regulation. The new rules went into effect in March, and with the DMA, the EU wants to prevent big tech, so-called gatekeepers, from cornering parts of the digital market by threatening the companies with huge financial penalties. The latest accusation means that Apple could face a penalty of up to 10% of its global annual revenue. Now, that would amount to fines of tens of billions of euros. The European Commission opened investigations into Apple when the DMA took effect in March. It also has a separate probe looking into whether iPhone users can easily change web browsers, and it has other cases involving Google and Facebook parent, Meta.
Chibonda, just talk to us about how Apple has responded to this.
Well, Apple has said it will continue to listen and engage with the European Commission. The tech giant doesn't just face fines of up to 10% of its global revenue. The financial penalties could rise to 20% if the offense is repeated. And right now, Apple has the opportunity to respond to the Commission's findings. Brussels will have to make a final decision regarding the tech giant's compliance by March 2025. Now, in recent months, Apple has said it has made a number of changes to comply with the DMA after feedback from both the European Commission and developers. On Monday, Brussels also said it is investigating whether the fees Apple charges developers breach its rules. Now, those fees include a charge of 50 cents for every download that companies are forced to pay for apps that are used by more than 1 million people. The EU's allegations show that Apple is facing a lot of pressure to its business model here in Europe. In fact, Apple has said it won't be rolling out its AI tech this year on the continent due to concerns over the Digital Markets Act. The tech giant says the EU's DMA requirements could force it to compromise the integrity of its products when it comes to user privacy and data security.
Chibonda, as we wrap up, just talk to us about the wider impact of the EU's competition rules.
Well, this is not the first time that we are seeing a tech giant delay the release of a product or a service in Europe over concerns linked to regulation. We saw that with Meta's Threads app. That was only rolled out in Europe 5 months after being released in other parts of the world. The EU has designated 6 of the world's biggest tech firms as gatekeepers. And those companies, which include Google owner Alphabet and Facebook parent Meta, are being forced to adhere to stricter rules in the bloc. Brussels says it is doing that in a bid to enable more competition and protect consumers. Now, these efforts aren't limited to Europe. In the United States, the Justice Department sued Apple for making it difficult for competitors to integrate with the iPhone in March this year. U.S. authorities allege that the tech giant's actions are raising prices for consumers as a result. So we are seeing Apple's business model face pressure on both sides of the Atlantic.
Let's leave it there. Thanks so much for your time and insights. That was Chibonda Chimbelu from DW. It's back to Zinathi now with your markets.